To make. The first is Michael Price is unfortunately not going to be here on April 7th. You have two alternatives. I can do a snarky summary and conclusion about everybody who's spoken to that point in a preview of what's going to happen, or, because I think is it a Thursday or a Tuesday? No, Tuesday. I was going to send you to go drinking early. So you can either cancel the class or we can hold it and take questions. Now, here is really where you ought to vote your preference. You're not going to hurt anybody's feelings. How many people want to cancel the class? How many people want to come and listen to the description of sort of a summary, which I do anyway, of the speakers? All right, those who want to do that, just come by my office. I'll be in my office for the whole class, and we'll let the others out. All right, there are also handouts coming for Andrew Weiss. It's a one-page. You can either post it. We made copies for you all. It's worth your doing because actually he has the single most extraordinary record since 1991, including every year in this crisis. His average return is about 18.5–19% after fees that can only be described as exorbitant. And he never has had a down year. So he does a certain kind of technical investing. It might be worth your while if Kevin gets him to do that. Now, the speakers so far, and we didn't orchestrate this because obviously we arranged the speaker dates to serve them, are very close together, as Bill Nygren pointed out. First, they are successful. These are all people who've outperformed the market over long periods of time by more than the value premium in general. What characterizes them is they're almost exclusively domestic. That they are domestic investors, they have been. The second thing that's come out, and I think the real lesson of this, is Bill Nygren. Character is more important than ability. Now I'm going to say something. Bill Nygren losing 15% of his portfolio on Washington Mutual is almost unforgivable. Why? For people in this class, what's the way to make money in banking reliably? Dominate local markets. It's M&T, it's Wells Fargo's strategy until who knows what they're going to do with Wachovia. People who go all over hell and gone always get in trouble. WAMU obviously was going all over hell and gone, and there was a lot of evidence, if you bothered to look at the balance sheet, that they were suffering a major hemorrhage of deposits that was having to be replaced by the Federal Home Loan Bank Board. But that notwithstanding, what is it that saved Bill Nygren's record? It was having the character to stick with value investments at the trough of the market. And that's a lesson that obviously Mason Hawkins articulated explicitly, but I think you want to listen to Bill Nygren on that also. Character is as or more important here than raw ability. 3, these are people who believe in moderate diversification. They're not doing complicated insurance of these portfolios. They're not doing extreme diversification. So they're right in the middle of the spectrum on that, and they seem to sleep pretty well. 4, they are clearly earnings, franchise, Buffett oriented. If you're going to do that in competition with them, I hope you feel slightly comfortable, because although they're getting better, I think you guys in this class have a better notion of what franchises are. But the last thing I would emphasize is they are very management focused, which is not something we talk much about in principles of value investing. It is understanding what that management can do to you if it's bad enough. And if there's one lesson I take away from these two, it is the degree to which they focus on management friendliness in managing costs and in allocating capital. Now, Tom Russo is actually the international version of that. And he is the first non-domestic investor, not only in this class, but really he is one of the first value managers to go overseas and reap corresponding benefits from that. In other respects, he's very much like them, but in the process of going overseas, there are issues of risk management, of management assessment, and cultural assessment that you really have to layer on to a basic value approach. For that and other reasons, so he does 0 through 5 pretty much the same as they do. It is a great honor to have Tom Russo here.
Thank you very much. That's great company to be included amongst, and thank you for the chance to speak. And it's been fun. I've had a chance to do this over, maybe the past 10 years now. And what I can say to each of you is that ultimately, I and Bill Nygren and Mason Hawkins and all of the others who are here speaking to you enjoy the prospects of you coming forth into the investment management business, and we'll see you at meetings going forward in time. And hopefully, if the lessons that I impart and that they impart enter into this realm of what Bruce just referred to as the character-oriented or the value-based factors that lead to good investments, if we impart some of that to you, it will help keep you out of trouble. The biggest trouble on Wall Street seems to arise from the most precise solutions for how to eliminate the risks of Wall Street, and that precision, unfortunately, is typically false. And if you don't get the character and the big questions of corporate culture and miss those, no amount of precision in the kind of analytical work you might apply in security analysis will save you from mistakes. And so, if you listen closely to what others have said and what I say, and take some of those broader principles to heart, you'll be better at the task that you're about to embark on as your professional career, and we will suffer from the better competition that you offer going forward. But that's a cost that I'm certainly willing to bear. I had the pleasure of sitting in a course like yours 25 or 30 years ago when Berkshire Hathaway's chairman came to speak. At the time, I think the market cap of Berkshire was $300 million, and he was worth $120 million. And fast forward to today, you know what the numbers look like. And it was just by the application of fairly simple, non-elaborate investment principles that got him to the place where he is today from the starting point, which is where he was when we met with him in 1982. So I will not have a substantial amount of, clearly I won't have the type of academic rigor that you will hear from other investors. I may not have as quantitative a presentation, and it won't have one case which will end up looking like I made a really good decision. In fact, at the end of this discussion, if we have a chance to talk, you probably are best advised to ask me about my worst mistakes, and those are much more instructive than if I showed you a case that worked really well, which is devoid of the real learnings. My presentation won't seem that sophisticated, and I was reminded of this when I spoke recently at another business school, and a person before the meeting asked me if I'd read Fooled by Randomness, which I think was by Taleb, is that right? And he described to me all of the risks that exist in the investment world, and how an approach might be to simply keep your money in treasury bills and then shoot for the optionality, the fat tails, and to create optionality off of that and keep your money close to home, because after all, investing is terribly uncertain. And I thought about that for a moment, and I realized that what I try to do is also to create upside but reduce my downside. And I find the example of Nestle, which is a company that we'll speak about, to offer my investors a similar return profile, but one that might be a little advantage to keeping the money in treasury bills. In the case of Nestle, I would allege that their core business, which is based on a broad portfolio of cash-generative properties, brands, in mature markets, gives them a bond-like component. So with Nestle, we invest in a company that has a bond-like characteristic in their steady and mature business, but they're able to create optionality through the ventures that they fund, and they do that with a substantial leg up. And the leg up that Nestle enjoys in going forward is they enjoy the benefit of having brands that have been in markets for a very long time, so the brands are coveted and of an aspirational nature, and as the countries in which they operate, which are 140 around the world, prosper, the consumer who can afford to reach into the market that they have is able to purchase Nestle's products in an increasing fashion, and in so doing, they return off of the venture investment that Nestle will make in developing their markets in foreign and emerging countries, increasing the likelihood that their venture investment pays out. So there's a core that's bond-like. They have brands that they take abroad, backing with venture spending. They have management who understands how to deliver the business. They have relationships with retail. They have insights that are lost to a startup in most markets, and they have legacy. I think you create an investment return. It's not sophisticated, is what Mr. Taleb would suggest that one do, but it is the source of risk-adjusted returns that I think are quite attractive. I suspect, but I'm not sure of this, that you may have been to see Berkshire. Has this group been out to Omaha? Okay, well, if you get a chance to go at some point, you'll be impressed by the simplicity of his message. And I was at the annual meeting last year, and someone asked him what the core investment principle is that he abides by, and it's Aesop's fable. It's as simple as that, where he said, basically you're taking $1 today, and you're investing it with the prospects of more later. A bird in the hand is given up for birds in the bush, and what you're looking for is really how many birds you'll end up with in the bush and how soon you'll get them. It's not much more complicated than that in the investment business that I practice, nor for Warren. And his observation was, I thought, very profound. He said, it's as simple as that, and it's as hard as that, because it requires enormous amount of planning and research and then patience. And that's in Wall Street, where the message is to ready, shoot, and aim. The process of trying to set up your investment beforehand and then holding it for a long time is a lesson that's lost regularly. And so I think that's important. I'm a value investor, which means that the discipline is to try to invest in a future stream of cash flows at an attractive price today. At Berkshire's annual meeting many years ago, in the midst of the internet bubble, Warren described the folly of overpaying for the prospects of future growth in a way that I would share with you because I thought it was very instructive for me at least. It had to do with Cisco. And at the peak of the internet boom, there was a person in the annual meeting who stood up and asked Warren whether he had any technology analysts at the corporate office helping to make sure that he didn't miss these great opportunities in technology that were driving the market upwards. And Warren said, no, he didn't. And the guy said, you should. And then Warren said, if you feel that way, why don't you take a booth outside the auditorium and people who want to give you their money will come to you. But he said, from his perspective, the problem was one of expectations. And he framed it this way, which is quite useful. He said there was a company, Cisco, that had a $550 billion market cap that at the time was reporting $1 billion of profit. And that was a sort of excessive valuation that you would have seen at the time. And everybody owned the stock because it was working so well. He said as he looked at it, first the billion was probably overstated because of accounting gimmickry. But the second point was that he looked at that investment. If he had to put up $500 million and he normally could get 6% on that money, in the first year he got $1 billion back from reported profits. He was basically $29 billion in the hole from what he would have received if he had kept his money in his hand. And so instead of thinking about the return based on the $550 billion, he added to the next year's hurdle the 29 opportunity costs that he didn't make. So at the start of the next year, he was really invested $80 billion in that investment, at which point the company, according to the great forecast of the day, was going to earn $1.5 billion. And so, he had the same math for that year, and he docked the investment $30 billion, so he was now close to 600 in the hole, and it was earning $1.5 billion, and the next year it was going to earn $2.5 billion. So as he played that out, it was a question of whether the company could ever catch up. The reality is the answer was assuredly no, and this is the problem with growth stocks, is that the very allure of what Cisco seemed to offer when it commanded that kind of a valuation set most of Wall Street in motion, creating businesses that would compete with Cisco. Venture funds amply recruited Cisco's workers to go form separate companies, and before you knew it, the world that Cisco faced was a much more competitive world because the appeal of that high growth sowed the seeds for its own inability to deliver because competition came in based on the sizzling prospects that company offered. And it just reverses on its head the way that you can make money in investing, where you buy something that's undervalued to begin with no expectations. It then in turn grows, and your investment cost fixed up front becomes increasingly undervalued as the business shows its ability to grow from its intrinsic value upon investment at a rate, and your investment then is a discount to begin with and is drawn up alongside of the growth in the value of the business. I experienced that, for example, for a long time through investments in Altria, which is the parent company of Philip Morris, when for years it traded at an enormous discount to its value because the fear of the American investor over litigation meant that nobody would apply a multiple worthy of the business's intrinsic value to the shares. And during that time, what Altria was able to do was to take all of their cash flow from the North American operations and reinvest behind global growth, so that over the course of time, they started with $5 billion of profit in North America and $1 billion abroad. And over the ensuing 15 years, the U.S. profit stayed at $5 billion, but the international profit at the end of the day was closer to $15 billion. We were able to invest in it comfortably throughout the whole period of time because it remained undervalued as a result of the concern over the risks that were knowable, and the market didn't pay up for the ability for it to grow. And so the initial investment undervalued as it were, and then the company's compounding in value subsequently meant that as a value proposition coming in, we enjoyed the benefit of a sharp compound going forward. So I tend to spend my time looking for businesses, spending all of the time thinking about the prospects that a company like Altria will succeed in its mission of developing its business abroad, whether they have the brands and the people and the tolerance for investing in growth, even though it depresses current earnings. And that's really where I spend most of my time, in the broad discipline of academic finance that Wall Street embraces heartily, is something I really spend very little time on, with one exception, and that's the field that Bruce will touch on frequently, which is behavioral finance, and the kinds of predictable mistakes that investors make, and I would count myself among the mistaken in that area. And two that I would highlight. One is a commitment bias, and I was introduced to that concept by Seth Klarman after he spoke at a Grant's Interest Rate Observer, and he described a reality which I'm certainly victim of, which is that once you make an investment, everything that you read about it subsequently is filtered in a way that confirms your wisdom for having made the investment, and it's surely the case. And so I know for myself, I'm an extraordinary critic of new ideas and a big fan of my existing holdings. And so you want to make sure that as an investor you can keep that instinct in rein as best as you can. And then Bruce has described another one after the 2008-2009 market crash. He described one which Columbia, Bruce alleged, probably had done the least good job protecting investors against. The three things that he graded himself on: one was security analysis, and he gave Columbia high marks. The other was risk, was asset allocation, for which he gave Columbia great marks. And the third, which I found most intriguing, was risk management, and that has to do with the portfolio balance. And he made a point which I gather is the subject of academic research, which says that a portfolio manager like myself underperforms in the portfolio that they deliver for investors what the portfolio holding would have delivered if it were equally weighted. I find that to be very interesting, and certainly in my own portfolio, I have 30-some percent, maybe 33% of the assets in three names: Nestle, Berkshire Hathaway, and Philip Morris International. And for example, in 2009, the portfolios I oversee were up 27%. Those three, the largest of all positions, were only up on average 14%. So it's an example. Now, I did that with the idea that those, to me, are the best risk reward investments that I can find in the world, and so they receive that allocation. But it doesn't always work that they will deliver. I thought of that reality as the source of my future returns, my coming years, because the businesses grew in value more than 14%, even though the performance of their shares were somewhat weak relative to the overall. And this year, for example, Berkshire in that setting is up something like 25% year to date. So it's making up for the amount of time. The notion about being a value investor and watching what you pay going in is you rarely get opportunities like Philip Morris was when it was a U.S. company burdened by low expectations, but a powerful wealth creator through the international investment. It doesn't happen that you see things like that very often. But the notion of buying well as being an important component of the returns showed up in Berkshire's annual this year when Warren suggested that since 1965 the book value of Berkshire had compounded at 22%, but that the shareholder return, which is simply the movement in the share price over those same 45 years, was 23%. So it was a 1 percentage point greater. He happened to compound the total book value at 440,000% over those 45 years, but the share price went up 830,000%. And the difference was that when he invested in Berkshire, he paid a discount to its book value, and today it trades at a premium. And that crossover over time added 400,000 percentage points over 45 years. And I think those are the percentage points that you want to shoot for as investors when you graduate. The extra 440,000 would get you a long way, that's for sure. I'm going to try to move this thing forward here. Part of the presentation left. Okay, so as I said, it's going to be a little more color than you normally get and more contextual. This actually reminds me of the comment about Bill Nygren. This is a Cape buffalo, and in 2008 in June, my family and I went to South Africa, and while there, not only did I meet with the heads of 2 of my portfolio companies, but we also went searching for the Big 5 game. And as we did every morning, we'd get up, and the guide would show us one animal after another, lions, leopards, chameleons, anything we'd see, anything at all. And invariably, they would say, if you separate from the group and you find yourself alone and you see this animal, whether it's an elephant, a rhino, black rhino, lion, leopard, whatever it was, and they start charging, stand still. And if you stand perfectly still, they'll avoid you, they'll ignore you. And we went through 3 days of this, and finally we came upon this thing, and they said, that's a Cape buffalo, and if you ever separate from the pack and you see one of those charging you, run like hell. And the story there is a lot like what it felt like being an investor in 2008, because throughout all of the market cycles beforehand, what we had been told is you find your portfolio, test it, make sure that the positions are what you want to stay with, and then, in a market downturn, use it as your friend. You can add to your positions and all the rest. And when you go through something like 2008 and then early 2009, the question is whether or not you're facing a Cape buffalo, where what you've been disciplined at doing for all those years no longer works because there's something new in afoot. In a market like 1999, when Cisco was egregiously overpriced, you could comfortably stay the course. In a year like 2008, going into 2009, when there was a whiff of financial catastrophe, systemic, it was much more difficult. And when Bruce gave Bill credit for staying the course, it involves character. It also involves client permission. I mean, we manage money at the mercy of those who entrust us their funds, and they run in any animal, and we're supposed to stay the course. And every once in a while, you have to confront something like that. The payback, however, is interesting. I look at the returns for Sempervic, the partnership that I'll maybe be able to show on the screen, but the reality is in 1999, the partnership was out of step with that egregiously bull market of the internet time, and we were down 2%, and that year the market was up 27%, and I allege it's the best year I ever had because my investors allowed me to stay the course investments in things like Altria, Nestle, or Unilever, Diageo, any of the kinds of consumer brands that I focus on in global markets. They let me stay the course, but with investors who have different expectations, they would have been desperate to catch the wave that seemed to reward so easily, and there would have been a pressure on the investment process to give the investors what they want. And the ability to stay out of step like that in 1999 had a very important consequence. And if I look back over the 10-year record from this point back to, say, February 2000, 1999, February of 2000, I guess it would be now, our return's an 8% compound, and the S&P's down 1.5% per year compound. That return only came about because we didn't flinch and run into the seeming warm embrace of Cisco at a time when staying your course paid off. And I don't think in my career I'll ever see a period of 10 years with an 800 basis points outperformance. It started, however, at a time when I was most out of step with the market than I'd ever been, a full 29 percentage points behind the market in year 1999. So this stands for the value of staying your course. The next is just an expression of what Berkshire referred to, and I certainly believe it. The question, and this is very research driven, what will be the payoff in the future for what you give up today? The best businesses in this area have one common feature, and that is that they're willing and able to make investments that are currently oftentimes consuming of reported profits. So if you start with an investment in the company that's directing their cash into new markets, into new businesses, you're going to have a business that underreports profit for quite a long time. And the vast bulk of companies in America, less so in foreign markets, but certainly in America, adopt just the opposite approach, which is that they tend to take steps that over-report current earnings and end up harming their long-term prospects. We saw that more clearly in 2008, 2009 than ever before, because by that time, Wall Street had created a fiction amongst companies in North America that if they were willing to use the commercial paper market to fund their entire liability structure, they would be able to report much higher profits because the cost of commercial paper at the time was below 1%. And the normal cost of borrowing would be 4 or 5%. So much of corporate America going into the crash of 2008 was exposed to the credit cycle in a way that was imprudent from the start, but involved the business's desire to over-report profits near term by transferring a normal balance sheet exposure on the credit side to overnight money. And they were assisted in that process by Wall Street, who had instruments that would surely allow them to swap their commercial paper into 5-year notes, to swap their dollar liability into foreign currencies, to do any number of things, but for one problem, which is that they presumed that markets would stay open. And the risks that were taken in terms of the owner's wealth by companies that were willing to take a very dangerous position relative to their funding was revealed when Lehman blew up, the commercial paper market closed down, and companies like General Electric, which had $100 billion in overnight paper, found themselves without a recourse for how to fund their business. That was the most egregious, but there are countless examples of corporates in America that found themselves in the same position. It was based on inverting this sort of scale to favor the current and risk the future. Our largest holding in Berkshire did just the opposite and has paid a big dividend because of that. Going into that same moment, middle of 2008, Berkshire had $55 billion of its assets in overnight paper. So Berkshire, completely in contrast to General Electric, which tried to overstate its current income by using overnight borrowing, Berkshire, in its desire to preserve its wealth, kept all of its money liquid, earning only 70 basis points on $55 billion. So the flip side is Berkshire is effectively underreporting its profits by the amount that they didn't make on that short-term money, waiting for an opportunity. GE overstated its profits, thinking that the market would reward them. In a crisis, they had to go to Berkshire, and he offered them 10% money, and they were glad to get it. He offered Goldman Sachs 12% money plus warrants. They were delighted to get it. And it's the discipline of holding on, focusing on wealth, not reported profits, that leads the scale to favor certain investors over others. And I think it's an important lesson. As far as the character that Bruce referred to, it's equally important to find quality characters to run your business. Most public companies, as I said, run for the short term. It's less in foreign markets because the compensation doesn't drive returns based on short-term results nearly so much as in the U.S., where so much of the compensation is driven on options and equity options and meeting near-term objectives to show smoother than natural results. Foreign companies have less of that. And this was a graph that was shown by The picture shown by the CFO of Nestle at one point when he described his time as the country head in Japan. And he liked this picture mainly because of the temple, which he said was 700 plus years old. And he said there's not a single piece of wood in it that's 700 years old, but the temple itself is 700 years old. And what that stood for to me was that much like this temple, a company like Nestle has core values. If they're right, they have to be replaced generationally. And there are very few companies that are able to create a culture that's owner-minded, that invests for the long term, even at the cost of short-term suboptimal returns. And Nestle is one of those companies. And I thought that this graph, this image, stood for something quite important. In Nestle's case, for instance, they invested years ago in a company called Alcon, and they put $200 million into Alcon, and for the ensuing 20-some years, Wall Street urged them every step along the way to exit it because it was non-core, it wasn't earning enough, reporting enough. But over those 25 years, that investment of $280 million grew to $40 billion. And we are much better off as investors in Nestle for them having the wisdom to defer realizing their returns in that investment and allowing them to grow. And it was a position that lasted through probably 3 generations of senior management at Nestle, but they all viewed the same story in terms of the potential for the return in the future, and hence they held against Wall Street's advice all along the way. There's an interesting side note to this, which is that now Nestle has $30 billion in cash, which they've received from the sale of their residual stake in that company. And Sanford Bernstein ran a survey of institutional investors recently about Nestle, and the report back was across 1,000 traditional money managers. The main complaint about Nestle was that they were complacent and somewhat slow-moving management, which of course, they moved quite slowly in this position to a $40 billion credit to our account. But the other thing that was the source of the criticism of Nestle at the moment was that they had $30 billion on their balance sheet in cash, and that wasn't efficient, and that wasn't optimal. And in 2008, we saw what happened with really efficient balance sheets, which is that they ended up compromising the very viability of the companies that they supported. And that lesson, only a year and a half old, has been forgotten. Memories are short on Wall Street, and the advice from 1,000, maybe from 999 investors, was that Nestle had to get that $30 billion into the market pretty quickly because it wasn't a very efficient use of their capital. So the first one, stay the course. The second picture, the payoff of deferral, and the third one, which is the corporate culture that stands against time, I think is really the 3 things that I harness most forcefully as an investor. Much of this stuff that I pursue as an investor came through my time with Berkshire as a student, just like you, and the 3 points that were made by Berkshire at the time were, all Ben Graham, that invest as though you're buying a piece of a business, not some trading instrument. Understand the market's myopic and it vacillates between fear and greed. And the last one is invest at a discount so you have a high enough margin of safety. Those 3 rules are really the cardinal rules for what we do. He added 2 other aspects to the story which were most valuable. The first was that the government only gives you one break as an investor, and that's the non-taxation of unrealized gains. And so that means that you're supposed to think about buying investments that can last a lifetime. He said to us that in a lifetime you only get 20 good ideas, and so you better think long and hard about committing capital. And so there's a tax advantage if you manage money for families like I do of finding investments that you can hold for a long time. Analytically, it raises the bar because you have to be darn sure of what you're doing before you go in, and that has a very high value. So The fourth point he made had to do with the tax deferral of unrealized gains. And the fifth point he made was you can't make a good deal with a crooked person. You can't make a good deal with bad people. And that really gets to the heart of the culture of public companies. And for me, since I spend an awful lot of time on that, I have ended up finding that the best place for our capital has been to invest with companies that have an owner-mindedness that's evident through how they operate, and very often those companies are family-controlled. So in our holdings, Berkshire Hathaway, let's see, how do I get to, let's say, page 20 or something? I can actually show the portfolio if you'd like. Here. All right, we'll go down the list here. Okay, so just this thing here? That's quick. Come on. Okay. Okay, I've exhausted it. Sorry, folks. Go to the back again, the last slide. Keep going. Here it is. Here it should be. It doesn't want to refresh that page for some reason. That's good. Yeah, that's it. There it is. So anyways, Nestle's not family controlled, but their values are as though they were. When the chairman responded at one point what his planning process was in Nestle, he said that at Nestle they have a 35-year planning horizon, but they break it down into 5-year increments. I think most American companies would be hard-pressed to have a 35-minute planning horizon. Berkshire Hathaway is controlled by Buffett. The Heineken's still controlled by the Heineken family. Richemont's controlled by Rupert. Sad Miller's controlled by the South African family. Pernod Ricard by the Ricard family. Comcast by the Roberts family. Brown-Forman by the Brown family. Anyways, it's a very unusual portfolio from the standpoint of trying to align our interests with the decision makers who make the most important decision for us, which is how they reinvest their capital and whether they do so with the owners in mind or whether they do so for management's sake. So the fifth point that Berkshire made was you can't make a good deal with a bad person. And then the professor in my course, Jack McDonald, introduced his own advice at the same time, which was don't be provincial as an investor. And in 1982, that was a really big message because he said 5% of the world lives in North America, and we have 50% of the world's equity market valuation at the time, maybe even more. And there are tremendous opportunities to look abroad, and at the time it was very tough to do so. But it was good advice, and I took all this stuff in stride and came out of it with an idea that, yes, I would focus on the long term, and for me, the companies around which I spend my time are food and beverage and tobacco and media companies, which all have a certain type of a franchise value. And then I'd look overseas, which was quite unconventional in the 1980s to do so, and it was really hard to implement because currencies were not freely tradable, and it was very difficult to make investments in foreign companies. In fact, Nestle, first investment, at the time you couldn't invest in the common shares of Nestle, you could only invest in participating certificates of bearer shares, and you couldn't buy many of those. The mindset of American investors at the time was also a great impediment because when I talked to prospective investors back then about the virtues of getting some of their funds overseas in companies like Nestle, the answer was invariably, but what about the accounting risk? And Nestle then only reported a very meager amount of information semi-annually. They had a decent annual report, but they would only give you sort of interim sales figures and the most summary report in the 6-month period. And so and that was probably a standard treatment of accounting, and Americans at the time felt how could you invest without the assurance of American accounting? And my response at the time was, what Nestle offered was more than enough for my needs, because really it was about the culture and about the ability to redeploy their capital. And the question about accounting was really answered in compared to what? Compared to American accounting, which time showed after that period that we've had the world's worst accounting frauds in America. So it hasn't been a problem so much as it was perceived early on. The other question invariably asked about early global investing was, well, what about the currency risk? And again, my question back to them at the time was, compared to what? Because the risk was only defined as being the exposure you have as a non-American. And I, in a class much like this, had many classmates who were from abroad, and invariably the international investors had a leg up on us because they knew that in no case would any of them, as often wealthy family members, would ever consider putting all of their money in their home country, because they realized the peril of politics. And Americans in the early 1980s felt supremely confident. And over the 25 years that we've had foreign companies, the exposure to currency, not the reason we invest abroad, but the added factor of currency, is that we've had a tailwind of about 0.5% compound per year based on the contribution that's come from just the currency effect of being invested abroad. So those are the main factors that I took from the early experiences that I had as a student, of course, much like yours. Take a look. I thought I'd spend the time just looking at three companies that have global value characteristics, if I can find them. And they stand for different, take it all the way back to the top if you could, and then I'll work my way back. Oh, that's good. Okay, so we've gotten through the buffalo and the dove and the temple. Here are the returns. As I said, 1999 in this figure would have been the best year I ever had, because it was the time when my investors allowed me to not run away from that charging Cape Buffalo. And the reason it worked so well is if you look at the subsequent 3 years, we avoided all of the collapse that ensued from the highly overpriced shares that predominated the returns of the major indices. So Nestle, why such a fan? They have broad global reach. They have a portfolio of brands which, if you're let's pick one, if you're a Nescafe consumer, the chances are good that if somebody offered you a Sanka, you'd say, no thanks, I prefer Nescafe. And with that brand loyalty comes pricing power, because the consumer doesn't believe there to be an adequate substitute for the product. And so this is a company that has, it looks like it probably has something like $25 billion brands, and they just enjoy an enormous amount of continuity in terms of the cash that they generate. And in the case of Nestle, they've taken the cash from the strong brand presence and they've redeployed the capital. I think of one example, and since it's stodgy, and since it didn't report quarterly numbers, and since they had a 35-year planning horizon, it just didn't suit American investors. And so you had this undervalued situation that lasted for years, where the price to earnings was quite modest, and the potential was unrecognized by the market. But the most important thing that they understood is that in order to realize their value, that there would be times when the investments that they made would cost them. And I think about Nespresso, which is the upper left-hand corner. It's a brand that they now have, but they struggled with it in the research labs for about 12 years before they launched it. And it is a coffee system that they enjoy today that does about $3 billion worth of revenue. During the early years, they were burdening the income statement with the costs of getting this product to work. And today, the $3 billion consists of some equipment sales, but basically it involves the sale of small cartridges that have, I think, an infinite gross margin. And if you look at this, it's now their. Let me see how this looks here. This is the performance of their brands. This is a $3 billion brand that grew at 39.5% in the year 2008. That was a business that they stayed with. It cost their income statement a considerable amount during the development phase, but getting it right made all the difference in the world. I'll tell you a contrasting story. Kraft during this time got wind of this coffee system, and since they had a fairly important position in European coffee, they thought that they would have to rush out a similar single-serve product. The single-serve nature of this is important because people increasingly live alone, and they don't want to make a full pot of coffee. In case of espresso, it's a better quality espresso you can't make yourself. But Kraft wanted to hurry a launch of a product that would compete with Nespresso, and they came out with something that was poorly researched and delivered called Tassimo, and it was a flop. It turns out that when the successor to the then head of Kraft described Tassimo, it was in response to a question that was asked her by a pithy Wall Street analyst who said, "Tell me what percent of your business is new each year?" And she very quickly and rightly said, "That's the wrong question to ask, because we can give you new, but if in the rush to give you something that's new, we sacrifice the portfolio that they enjoy, you'll end up with a situation like Tassimo." And in their case, because they wanted to have a product in the coffee space that would compete with something that looked like it had legs, they rushed Tassimo to market. It was a flop. It was designed to make sure that they kept up with Wall Street's desire to have a high percentage of the revenue each year from new products. So it was an overinvestment in new. But the real tragedy was that it came at the expense of maintaining the proper investment spend, marketing spend, behind what was a terrific core coffee business that they had in Europe. And so Nestle, by contrast, worked slowly, carefully, built the product, and the payback has continued. This year, which is the 2009 year, it's up 20%, and there seems to be an extraordinary opportunity in front of them still because of the increased penetration around the world.
Can I stop you
Sure.
with this question?
Sure.
It's actually not on the list here, although a lot of people are concerned with this brand. A lot of those brands are bought, and they're bought by buying companies that are above market values.
Yeah.
And not all those acquisitions, particularly the water companies, have worked out. How do you take something like that into account when a company like Nestle grows?
Well, it's one of those things. They have to be willing to stand in their own way. Now, for example, they just acquired DiGiorno. DiGiorno they have $30 billion. And the hot breath of Wall Street is right on their back saying, spend it. Spend it, spend it, spend it. So you can imagine the pressure that they feel to spend the money because it's not efficient to hold $30 billion. Now they've implemented a share repurchase, a $25 billion share repurchase, which is a very important way to return capital so long as your shares are undervalued versus their intrinsic value. But if they'll only spend a certain amount, they still have a lot of buying power. And Nestle came in recently to the Cadbury acquisition, where there's a fight for Cadbury, and the buyer was Kraft. And Kraft knew that Nestle had $30 billion in its pocket and could be a buyer of Cadbury. And so Nestle was offered DiGiorno, which is a pizza company that Kraft had built, and they were offered at $3 billion. And it was way undervalued relative to what DiGiorno was delivering to Kraft in the process of growing at 8 or 9% a year for a decade. And in Nestle's case, bringing DiGiorno into their portfolio, even though it cost $3 billion, which is about 11 times current earnings, EBIT, it offers them an enormous opportunity because they dominate the frozen food distribution. They have already Stouffer's, they have Lean Cuisine, they have Hot Pockets, which you may know is a perfect dinner for a student, which is sort of, and the head of Nestle referred to Hot Pockets as a perfect product because he recognized that 50% of all food is consumed away from home and 50% of that is consumed in the car, so a Hot Pocket is designed to sit in your cup holder. So when you eat on the run, you can grab it and gnaw it as you're driving along. But they have dominance, major market share in frozen, and they're bringing in a brand that will be elastic. So they believe, I think they're right, that they will be able to brand the Hot Pockets with the DiGiorno label. They'll be able to use some of the pizza lines under the Stouffer's or the Lean Cuisine line. They'll be able to extract from it brand synergies, which I think are going to be available, and certainly factory and distribution savings will be theirs to enjoy that Kraft didn't have because Kraft didn't have any other adjacent frozen products. I think it will pay out over time. They've made some bad investments, and Wall Street encourages them to spend. That is the discipline that they have to resist.
Do you ever consider selling when they make a lot of bad investments?
Yeah.
This company sell them?
Never.
All right, somebody here had a question about it.
Never. Okay. Here's why. I mean, this is the chart that keeps me at the table with Nestle, and it's the same chart that applies to so many of the companies in our portfolio. It means that you have in reserve, as companies move up the disposable income scale, they move from at 2,700 on the far left to having basically non-processed food. As they move up, they spend on processed food, then they spend on branded food, then they spend on branded food that have health and wellness attributes. But really the important thing is that where the world exists in the 2,700 GDP is the part of the world that has 3 billion people. It's a part of the world that is yet unpenetrated. And it's the place to which Nestle is committing its capital to develop and extend their existing products. That's really the story, is whether they're able to have an opportunity to redeploy their mature market cash flows into parts of the world where you're going to move to the right on the x-axis, and in the process move into what is already available but not yet consumed broadly enough. The great portfolio opportunity that we had during 2008, 2009 was that during the sharp sell-off in 2008, the emerging markets collapsed, and companies like Nestle, whose prospects were most bright in exploiting those markets, fell sharply in value. And we had still residual holdings in a series of domestic companies like H&R Block and International Speedway and Kraft Foods and Dr. Pepper, all of whom were at the heart domestic-only businesses, and they didn't have the ability to reinvest in foreign markets. In that sharp downturn in 2008 when the emerging markets collapsed, the share price of Nestle, SAB Miller, Unilever dropped even more forcefully. We sold American companies, received dollars. The dollar soared after Lehman collapsed for reasons that aren't obvious, but because of our financial crisis, there was a flight to the dollar. Go figure. And we took the proceeds from the sale of domestic-only companies and added to positions like Nestle. At the time, that decision was fortified by discussions that I had with Procter & Gamble, who were similarly positioned, and they used the same chart as this, and in their case, the example they described was diapers, and this example fortified me in allocating a substantial increment to the portfolio holdings in this type of company. And the story they shared about Procter at the time was that they had entered the Chinese diaper market in 2003, at which time the market was 3 million cases of diapers. And by 2007, it had grown to 50 million. Maybe it was starting in 2002, but the compound for that period of time was 40%, which was the type of compound that the market expected from emerging markets. In 2008, Procter shares collapsed along with the other companies that were exposed to the developing emerging markets. And in December, I met with the head of the company, and he described this diaper business. And he said that, in fact, in 2008, the business had grown from 50 million cases to 70 million cases. So in the face of what was a massive sell-off in the equity markets because of reduced prospects for emerging markets, Procter's investment in developing the category of diapers, which was an unfamiliar category in mainland China, and then the absorption into that marketplace led in 2008 to another 40% year of growth. What really cemented my interest in this investment thesis was that they said at 70 million cases, they only serve 4% of the target market. So they had very low penetration, they had nice brand awareness, low penetration, and that the 4% who use diapers only use one diaper per day per child. And so however many of you are parents would know that one diaper a day just isn't enough. And so it starts them down the path, but what was so forcefully expressed was the growth continued, the penetration was extremely low, and the frequency of use was extremely low. And so if you said from 4% you get to 6% penetration, and then instead of one diaper a day, 2, you can quickly see yourself marching up the scale economics of a business. Now, they weren't making a lot of money in the early days. They were investing, and at the time of the meeting, Procter said that they would commit to invest in the next 22 factories that they build would all be in markets like China. So they had a total of 25 planned projects for the coming 3 years, 22 of them invested behind the kind of growth that they could see in that company. And really this chart is what drives my continued interest, because we're still so low on that consumption curve. People often ask, okay, fine, you're interested in the international, especially the emerging developing markets, why not invest directly in those markets? And I have a couple of responses. First, it's unfortunately the case, but regularly, all too regularly, you hear about the companies that are domestic only in a market like China adulterating products. I think of the milk business in particular, which Nestle competes in, and every 6 months or so you read about another company that had used a melamine additive to milk products, which end up killing kids, and they take out the head of the company and often shoot them or penalize them or sanction them however they can. But the fact is, that's not an unexpected outcome, because they have no other investment behind the action to rein in bad conduct. In Nestle's case, they can't spike Chinese milk with melamine, because if that happened, the cost to their consumer goodwill globally would be so vast that they're forced to be good players in a market that allows them to stay the course, and the risk of a local only is quite high on that dimension. The other thing is, at some point, even China will run out of rope in terms of having attractive reinvestment opportunities, and in which case an only Chinese company won't have the ability to take their capital and go to other markets. Nestle can move from one market to another. Then there's a whole litany of sort of quality of reports and sort of a corporate culture that keeps me more inclined to participate in markets like Nestle in China through the multinationals. To your question, do I ever sell? One example right now that I do own in the portfolio that's not international is Comcast. They're in the midst of buying NBC. That is a investment that's large, it's firm changing, and it may be enough to cause me to sell that position. it doesn't have the natural ring that the businesses that I've referred to has. Nestle, it's a question about the reinvestment opportunity. I'm going the wrong way here, sorry. My God. Okay, I think I'm back in business here. Another investment, I think, stands for a very interesting experience, which occurred in 2008 going into 2009, was Pernod Ricard. I spoke about it last year at this class, and it was still unfolding. I think if I go back 2 slides only. No, go back one more, I think. Is that Pernod or Nestle? No, go 2 forward then. 2 forward? Keep that one more. That's Pernod, but I think there's one just before that. It doesn't refresh. Sorry. Oh, okay, go back. I'm so sorry. It's I guess we're down to here. For some reason, those slides didn't take. Right there. Okay. Anyways, there's some more slides for Pernod. They don't exist, unfortunately, but here's the interesting story. Pernod, like Nestle, was very much involved with extending their business into developing emerging markets. So in their case, they have Chivas and they have Martell, which have become extraordinarily important brands for them in China, and they have a distribution system in China that they control. So they have route to market advantage. They have critical mass. They service the on-premise trade in a way that provides them with exclusivity, and in an effort to extend that strength, in early 2008 they acquired Absolut. And the idea there was that Absolut is a behemoth brand. I think it's 20 million cases, 10 million of which are in North America. And anybody who drinks copious amounts of vodka in North America would know that it's no longer a fashionable brand. Grey Goose and others have supplanted Absolut, and Absolut sort of has a tarnished feel. They still happen to sell 10 million cases in North America, which is an extraordinarily powerful brand, but it just it lacks the luster. In early 2008, Pernod signed a deal to buy Absolut, and the thesis was that the 10 million cases they had in international markets generally are very small shares of markets, and they've been distributed in those markets at the very high premium, typically, price point, by third-party distributors who had no real particular interest in Absolut succeeding. When Pernod offered to acquire it, they offered to bring in that business in-house and then wrap around it Chivas, Martell, Mumm, Perrier-Jouët, a whole cluster of products, and then when they went to market, they would use old-fashioned muscle to make sure that Absolut got more than its fair share. When accounts ordered the product, when they ordered the other 4 brands, they were asked to place just a little bit more emphasis on Absolut, and that's sort of market power at work. The investment community was dismissive. I was quite impressed by the low penetration in developing and emerging markets and the ability to move it up because of its self-distribution. Now, they made the they sealed the deal in March or April of 2008, and then the financial crisis hit, and they found themselves with a funding crisis. They had to pay for it in late 2008 when the credit markets had collapsed. And I had calls at that point from my closest investment friends at hedge funds who knew that I owned a large stake in Pernod, and they welcomed me and said, how was I feeling? And by the way, they were short Pernod. What the heck was I doing? And it was the #1 shorted stock on the Euro 100 because it was a perfect short for 2008. They had a credit moment in front of them which they couldn't avoid. And by the way, the world was going into a funk as the consumer would no longer pay up to buy premium spirits. So there was a short on the equity markets, and then this CDO market action started to roll through the markets, and in support of the short sellers, this suggested the imminence of their financing crisis. And so Pernod had to struggle with the fact that the costs of borrowing were ever escalating, and the suggestion was that they may not make it, as the fevered increase in the CDO values suggested that they may have a crisis. What they ended up doing was they sold one rather marginal small bourbon brand called Wild Turkey for $700 million. And then they did an equity right offering to all of their shareholders, which brought in another $1 billion. It broke the back of the short-selling thesis, which was one of credit crisis, because they then secured their financing. And the equities, which had dropped from, say, 70 euros a share down to 30 because of the imminence of the credit crisis, has spent the last 18 months regaining all of the lost ground. And you can see here that the credit default swaps have come back into a much more normal price. The first step that they took in the Chinese market, which gives you a sense of what they're shooting for, this is impossible to read, was that they took what was a small market presence in China, which is 50,000 cases only in a country of 1.3 billion alcohol-friendly consumers, and they took that amount that they had in the marketplace, represented by a third party, unloved, and it was priced at a discount price. They doubled the price at market, and then they lost half their volume right off the bat. But their insight there was, for the Chinese consumer to care about the product, it had to be expensive, it had to be aspirational, and they felt that they could deliver on both of those pledges, but they would have to lose money for a fair amount of time while they were building it up. They had substantial profits from their other businesses, which they could use to underwrite the cost of increasing its relevance to that marketplace, and others that are quite like it. And so I found that to be very, very encouraging. When you invest in international markets, you have all sorts of funny moments. And at the annual meeting for Pernod, I went and I read the annual report. This is sort of a lost in translation moment. And I read, and they said on the annual that the members of the Pernod family welcome Absolut into their company. They welcomed the Queen of Vodka. So I said to the CEO, the chairman of the company, what do you mean Queen of Vodka? You want to sell it to Chinese? You're not going to sell the Queen. And he said, no, you're absolutely right. It should be called the Emperor of Vodka. But in this case, literally, the translation, vodka is a French female word. And so if you modify that and make it the royal vodka, it has to be the Queen. And so just a small cultural situation. The last company I would look at is SAB Miller, and it's a company which we had an investment in for years through Philip Morris. They own 30% of the company because they sold the Miller Brewing Company to SAB Miller for shares, and I owned had 7.5% of our portfolio in Heineken, and really Heineken and SAB are rather locked in a global struggle over dominance in the developing and emerging markets. And so this is an interesting example of how I'm comfortable owning multiple expressions of exactly the same business, because I think both companies offer tremendous promise. Why I invested in Colombia at the time, in SAB when I did, which was in February of 2008, was I visited the management of the business in Columbia, South Carolina that they had acquired, Columbia, South America, that they acquired, and it's a 98% market share. So as Bruce always encourages you to look for, it's the local market dominance. Well, 98% is a pretty dominant local market story. The trouble was that those people who ran it really left an enormous amount of potential untapped, because they basically brewed it at the factory, and then they shipped it to the edge of the factory, at which point others picked up the brand and moved it through commerce. They had 350,000 outlets, and there was no price discipline in the marketplace. And so even though they were 98% market share, the consumer was asked to pay 45% more for the product than what the company had wished them to pay, and they just never bothered to go into the marketplace and discipline retail. And so in the margin mix, retail was making far too much money on this product. And they came up with a very clever idea, which was that they went into the marketplace with their 350,000 outlets, and they agreed with a series of prominent distributors, retailers, it is, to invest heavily in their particular site. They would give them free signage, free refrigeration, free glasses, bottles, chairs, umbrellas, and all the rest. And the only thing that they had to agree to in return was to sell it at the official price. And suddenly in markets all over Colombia, the reality was one of countless retail outlets became quite elaborate and offered the product at a much lower price. And so the draw into that now invested channel was driving the volume growth. And in those new outlets, women were comfortable going to drink, whereas before, they were pretty unseemly spots. And so they started to address half the market that was previously uninvolved with their brand on-premise. And most of the consumption in Colombia is on-premise, not off-premise. And so seeing what a terrific job they did understanding how to reposition the market to drive down the retail selling price, and then to invite in new consumers, women, through new packaging and new products, and then to reposition the portfolio, reassured me on the visit to Colombia that this was a company with extraordinary knowledge about the beer industry and could roll it around the emerging markets to come. The shares, which were at $28 in February, by November were $13. That's what happens when an emerging market panic affects the values, and so we were able to add to that position throughout that decline, but it did take the kind of courage that Bruce said Bill Nygren was asked to evidence when some of his positions went badly wrong. Interestingly, this graph, I think, is quite important because it shows you that during this time, the biggest promise for SAB Miller at the moment is, and also for Heineken, is Africa, which was the forgotten continent for much of my investment career. And 10 years ago, SAB Miller suggests that the cover of Newsweek had a picture of a Nigerian rebel blowing up Shell's plant, and it said the lost continent. And over the ensuing next 10 years, of course, the obvious happens. It's compounded its GDP in sub-Saharan Africa at 10% a year, and it's been the fastest growing part. And as that happens, consumers are starting to come into the marketplace, and this is a particularly interesting aspect of SAB Miller because in the region that they now serve, there's 400 million hectoliters of beer sold. 300 million hectoliters are homemade, sorghum-based, very poor quality, and extremely cheap, non-tax paid beer, homemade stuff. And only 90 million hectoliters are bottled, clear beer, and that's the market which SAB Miller and Heineken compete for. Their only challenge is to make their investments pay off mightily, is to convert that already consuming 300 million barrels from poor quality, unbranded and sort of low esteemed product over to the branded business that they offer. And so they're investing heavily behind that growth. And if you look at the EBITDA margin, what I'm most impressed about is they're willing to invest behind that growth even at the cost of current reported profits. So if you look at the EBITDA margin during this time, the revenues have grown by $3 billion. Volumes are up sharply. The margins are down, but that's concomitant with the investment that's being made, because when you start out, you're not going to get the kind of margins that you enjoy to begin with. And so I see this as not an expression of poor management, but actually I celebrate it as an expression of their willingness to invest using their income statement to support future demand, and with that, over time, will come a recovery in the EBITDA margin. That's it in terms of my review of a handful of investments. Nestle, it's the reinvestment opportunity. Pernod was the interesting intersection between the capital markets and the equity values, and SAB is, again, much the same as Nestle. They have enormous potential. I'm asked recently, with the collapse of the euro and the rise of the pigs, what do I do as a U.S. investor with foreign currency exposure? And it's been a fairly sharp headwind year to date. I think we've probably suffered a 3.5% adverse impact on our portfolio just because of the collapse of the euro and the pound year to date. I actually say, that the portfolio we have is really indifferent as to the long-term effect. We own the businesses not because of currency, but because of their ability to invest in markets I think will pay back handsomely. And the reason why the foreign market, or the European currencies are so weak in some ways, is that the area has lost economic vitality. It's lost that vitality to the parts of the world that we address with our products increasingly. The second point I'd make is that the opportunity that Nestle, Heineken, Pernod Ricard, SAB, Unilever are offered today to run their European business more efficiently, more effectively, has gone up dramatically because of the crisis mode that those countries now operate under. It's been historically impossible to come up with any kind of sensible work rules in Western Europe. And at this time, because of the crisis, our companies are able to consolidate plants. A perfect example would be Heineken, which struggles with an acquisition that they made in England. And in England, it's the worst beer market in the world, and there are 4 major players. Well, for the first time ever, under Heineken's guidance, the industry has cooperated to eliminate 25% of the British brewing capacity. And what's happened is that they now share capacity amongst companies to allow for higher capacity utilization to exist in the market overall. That leads to lower unit costs, but more importantly, it's led to discipline in the industry when they go to negotiate contracts with the powerful retail. And so Heineken, today when they go to Tesco, and Tesco says, we're not going to accept your price, you have to cut it, which has been the history of the last 20 years in the UK beer industry, Heineken can now say, no, I won't take that price. And they no longer have to worry about manufacturing capacity that's the dead weight. They can refuse without the fear of their plants dropping into under capacity.
Give a little time to questions, because there is
I'm done.
a stock, a lot of them want to ask.
That's it.
Jared, why don't you start
Yeah.
with Martin Marietta? And if the following people want to chime in, they should feel free to do so. This is the measure of interest. Paul Greenfield,
Right here.
Willem Schilpzand, Scott Siegel. That's probably enough. So do you want to start?
Sorry I ran over. Any questions?
Jared.
So, Martin Marietta's been a core holding yours for a while.
Yeah.
It's a cyclical business. The stock peaked in 2007, got a pretty rich valuation on peak earnings at that point. I know, calling it top cyclical, but it's had a gradual decline since with, major headwinds. You barely lighten your positions.
Like, you mean, in other words, is a 70% decline from the top enough? Well,
but it's been over, 3 years.
Yeah, no, 70% is a decline that you feel no matter how long it takes. But, I probably should have sold more when it got into the zone of kind of a cult-like status. I should have been more alert to that cult-like status. Now, it's quite clear that those assets in the ground, though they may suffer sale into cyclical markets, there is no more rock in the world. I mean, those who own it have a very valuable asset. And I'm sure you all know it's a natural monopoly because the rock doesn't ship well. It's very expensive to move it, and so if you have quarries, that they're I said the brands interest me because of the lack of a perceived alternative. That's why I like brands. You have pricing power with brands. In the case of crushed stone, it's not a perceived lack of alternative. It's a real lack of alternative. You can't get stone shipped into markets where you own the quarry from any kind of distance, and they're not zoning any more quarries. So in theory, though it's cyclical, the reserves are mispriced by the market, and you can see that by the kind of valuation premium that's been paid over time. The leverage that bid up the price was the sort of global leverage across all construction materials around the world, and I just missed letting go of more of it. I had sold stock, and I sold stock at higher prices. But anecdotally, the lesson that I should have learned is I was in London at a tobacco conference, and I was speaking about Philip Morris with a prominent UK hedge fund manager, and he really didn't know me other than I was speaking intelligently about Philip Morris, and he turned to me and said, "What's your position in crushed stone?" And I thought to myself, why the heck is he asking me that, other than the fact that from his perspective, and of course at the peak, it was owned by all of the major hedge funds, broadly owned, is that if I was smart about tobacco, then clearly I must be smart about crushed stone. I must own it. It was just so widely owned that should have been a signal that the very presence of that question meant that the last marginal buyer had piled in and was looking for a takeout.
Let me Matthew. Is Matthew Cohen here?
Yeah.
Go ahead and ask your question, please. It might be relevant.
My question was similar, but I was wondering how you get comfortable that you're not overpaying for the pricing power. I mean, I understand that the pricing power has remained pretty constant while their volume has come down very significantly.
This is the pricing power for Martin Marietta.
Yeah.
Oh, yeah.
Still on my
Yeah.
So how do you ensure that you're not overpaying for it?
Well, I think I was by virtue of holding at those prices that were as high as it got. Today, the price of stone relative to the concrete, relative asphalt, relative to the contract that is granted by municipalities and by the builders who use it. Price of stone is still very, very low relative to the total cost of a job. So, it's not the sort of variable that if they raise the price 8 or 9% will change dramatically the cost of a transaction. And so the pricing power is in part, you can model it in as being not a major component of the construction costs of what you're doing. And I sort of took an example in my own sense, again, believing in the value of scarcity under this example years ago with waste management, which was a consolidation of dump sites, which in fact are often former quarries. There was a story that Wayne Huizinga had consolidated the Florida market, and there was a story that a person was looking to get a dumpster, and there were 12 names in the phone book for people who would rent them a dumpster, and they called the first one, and they said, it's $50, and the person said, it's ridiculous, $50. It used to be 10, price is 50. I'm not going to do business. So I went to the next one, price is 50. Went to the next one, price was 50, and he went down the list like that. And finally the person said, look, you can keep calling, but the price is 50. And what it meant was that there was only one place to go, and the price was 50. And at the end of the day, that ultimately is the kind of power that the business has. Is there's no alternative. There is an alternative ultimately if they abuse that pricing power, which is that municipalities can zone new quarries and release supply into the market, which would break that message. And so ultimately, since much of the use for stone is for municipal purposes, if they abuse the power too egregiously, that it starts to surface in the total cost of deals in a way that becomes obvious, the government can rezone quarries. And so ultimately you have to restrain against inviting your customer into an alternative source. If they're disciplined enough not to do that, then it's a bit like that Yellow Page ad for 12 different sites. It is one price.
Let's take the last one. Jamie Wiggins here.
Yeah.
This is another one.
Martin, Jesus.
No.
Scripps Network.
Okay.
Yeah, and it actually was a pricing power question. Some of you are rephrasing it. It's a holding up there. They recently had a spat with Cablevision. They tried to get a hefty increase in the per channel fee. Going forward, I guess, who has most of the bargaining power in these negotiations when I'm thinking about a company that really owns only a couple of top networks?
Yeah. Well, one of the things with Scripps, and it's something that when I've met with Viacom, CBS, and some other companies, they said that Scripps found itself in that awkward position where they insisted that Cablevision pay them for carriage, a much higher MSO fee, and then Cablevision refused. Scripps had no leverage. But what CBS said is that when they went into the same negotiations with some of their cable charges to the MSOs, and they had pushback, they threatened the exclusive sports franchises that they have, much like what Pernod Ricard thinks that they will get by bringing Absolute into that portfolio. The portfolio effect is in play in the broadcast business. And so for CBS, who felt like they had, independent of the property that they were trying to increase prices for, power over the network because they could pull back content that they depended on in other areas, they were able to get through that negotiations with a high increase without any disruption. Cablevision looked at Scripps and said, well, we can muscle you because you have nothing else to offer. And what happened then, it became a public fight, and they finally got an increase. And ABC did the same thing, probably around the time of the Oscars. You probably saw that. The longer-term question is, how will you get paid for the content at Scripps? And at the moment, they've conceded a relationship with the MSOs as being the major way that they would get to the consumer. But they have content that the consumer covets, and they have other ways to get to the consumer. Increasingly with technology changes, they could go through the internet. They've chosen not to because they get such a large amount of MSO fees, but it's a trade-off. And as a business, it's difficult for Scripps to throw its weight around, even though those two networks that they command are very popular. They're not without an adequate substitute. There are other things that the networks could program in, and so it's a long-term question that the company faces, and it conceivably will lead them to become a part of a larger enterprise. So there's a chance that you'll end up seeing it acquired by someone else for that reason.
Tom, thank you very much.
Thank you. Thank you for the technology. Yeah, I really think we overtax the system. This one showed, but in so many of these other ones, this sort of got it wrong. For sure. Thank you. Uninsured services. Yeah. Hi. Hello. Great. Thank you. You should get something highly appreciated jump cards. So the only thing I'm going to have a problem with is this foundation, and it will hopefully help start with that. Thank you very much.
I'm serious. They're serious about this fund.
Now, what about Southeast? I gotta remind you, because you know it's Cara, isso é só isso. Isso é como só isso. Não tem outro jeito. Não precisa nem colocar. Mas essa eu vou ter que admitir o time dos casos. Preciso
More so on the.
Because think about it, if I get this, I thought you were really worth talking to. And I'll know, emails me direct, not using it. Okay? Rather than I just call. See, like calling calls to them. What I got to do is he gets really pissed off. One woman was just terrific. And all she wanted to know was how much I was paying. Where do you work? They don't hire me. And he's not going to 17 years pissed off. There's someone good.
Não, bacalhau.
Even if he doesn't have a job, tell him I can make another $1.5 million. He claims that he has a tax that gets 2% of the market. So it's kind of long. That's the biggest it's not bad. It's their opinion,
For what?
I don't have any. Just got it's about 5 points.
It's also
Yeah,
they do have they do have
One of the things that we could do for
in Europe, you have
is to organize subcommittees. So there are like 5
I don't know.
and when you order it, if somebody is over okay, so give it
It's an interesting topic, and I got a little more about it. It's the moment you're great.
No,
They sent out a press release. Rainforest coffee, you know. Great. More available. Despite that,
Did the anti-white stuff come out? I got
it's
it.
where I need package.
I can give you the post
Yeah, the premise was. And some night
Okay.
he's the Confederate. Hi, nice to see you. Yeah, sure.
I thought I used to work with Florida Rock when I was a kid.
Now we're talking.
And I remember before.
Interesting
And
family.
on the big family. And another big thing I noticed when I was a kid was sort of the asset value of just the land. The pieces as far as the area. Everything was focused as far as pricing power. And they were difficult to move the aggregate. Another thing is all the mineral rights and water rights they have on the ground. Not shown in power, you know, natural gas, and
Oh, so they have the full fee.
a greater
They have the full fee.
greater asset valuation for it's not part of it.
Yeah. And Chris, I really said when I first started this business, when are you going to go far? Why is it good business? Agriculture. But and then it's backyard. The fact is, you've got this hole around, you fill it up, and you fill it up, and you develop it. So you have 3 plants.
And the real estate's really beautiful, actually, as far as some of the ponds that are created from the mineral classes. Especially the things. So that was another real estate.
Yeah. And then you develop a community under the, and all that stuff, you know, it was wiped out with that $190 valuation. That was just-
Yeah, no, I think right now, if I was looking at it like today.
Yeah.
As it is value.
No, but the kid was asking for is, do you have a metric that you use to track how crazy the price is?
Yeah, I mean, mine was that anecdote, what do you do in the agriculture? The cost, and that doesn't know me. I think the value, I was asking recently, if I was a question about that, and they're sharing some questions, like, what do you do in agriculture? You know, I first invested in this stuff, nobody knew about agriculture. Now, ultimately, my risk is that, you know, I would be buying some of that other questions, so who would invest in? But Nestle's one that's a currency.
Nestle is fluctuating, but we have a Nestle position, and it fluctuates. It does well. The guys make a bunch of stupid acquisitions for a while.
Excellent steering and transportation.
But if they're going to get back from the pocket,
That 30 is still.
it's going to stay there. Well, what we were talking about, and I'm going to talk to you about next time, is you think we're a brain person. And in fact, we're just a brain person. Because if you think about what you're talking about yourself, it's the incremental value of distribution and refrigerated products where they have the local communities. And they can have it. When you talk about the next one, which is very hard, for liquor, because it's A, controlled, and B, there are a lot of the alcohol, again, it's distribution. And if they got the truck store, and they have to bring in some alcohol, you're going to, so you're in both cases talking about incremental value, not of a brand, but of a distribution.
Yeah.
When you talked about the third one, which is Savmore, and it's basically understanding, once you have the distribution, how to make the most money on it.
Yeah.
So one is just enjoying the fruits of the, and taking advantage of the distribution. The second is maximizing the value of the distribution.
Yeah.
And of course, that's also what's going on in York County,
Yeah.
which is where they want to cooperate and you still each other. And then the last one we talked about is, of course, where there are two fundamental distribution models, basically. So Sci-Fi Channel or DIY, House and Garden Channel,
Yeah.
have a buy the programs and they do the wholesale distribution. And then they have to do the retail distribution and their economies of scale and both.
Yeah.
And the question is, how do you get the most out of your share of a giant monopoly?
Absolutely.
And I would take it that the real bottom line for you is the last thing you mentioned. There's similar restrictions myself.
Yeah.
To somebody who can
It's not that long. I pulled on the fund. A lot of people call it Scripps.
Right.
Scripps Network?
Yeah.
Scripps Network.
Scripps Network.
Scripps Network.
Look.
But sooner or later,
Tim Miller, I think that's out there.
it's Jeff House.
Yeah.
So the thing is, you are, unbeknownst to yourself, a distribution
Also,
model.
yeah.
And the only non-distribution guy who ever did in your life was you.
Right. Right. And that was really thesis of that. But I didn't use it.
Right.
I think it's readable. Anyway.
So that's what I'm going to talk about. It's
Yeah.
rating investors like you, basically understand where the no, Buffett understands.
Yeah.
Yeah, Buffett is over. And he tries not to give it away. So he talks. Let's see. Yeah. So he talks about brands all the time.
Yeah, I mean, so he sort of worships Pope, and he's not Pope.
Yeah, it's distribution muscle.
And what's intriguing about this doing these different industry is ultimately, I think he realizes the truth of it. Franchise laws are background.
Right.
And there's diseconomies of small scale that lead to too much margin. And ultimately, this was fascinating because the four areas, local television, car dealers, beer, and those are the main ones. And we're talking about it. And all of those built their model around exclusive regional franchises. Because when they started, they didn't have the money or the local knowledge. They have a vertically integrated down to the last consumer distribution system. And now, ABC does not need local areas. GM does not need local areas. Otherwise, we're going to something else in Walmart. CCE was bought by Coke. They didn't need the local distributors. The most fascinating thing I talked to the guy who did that. He said, wasn't the problem the increasing amount of bottles and soft drinks that are going to warehouse market? The real problem is that Walmart is the largest restaurant in North America. They sell more fountain than anyone else. And Coke deals directly with Walmart on fountain. But they had to go through 50 different local bottlers to fill up the store with bottles. And they just couldn't get the pricing they wanted.
Well, the reason it's not that simple. And the reason they did CCE is not a lot of little bottles.
No.
One big
Yeah.
So why that's not an argument for wanting CCE.
Yeah.
The reason they did CCE was that they could not control it. So what they did was they stepped away from the competition. And they entered the year where the stuff was owned by this family.
Yeah.
And they loaded it up with debt, so the bottle was never going to be a price for it.
Yeah.
And then Pepsi did the same thing.
Yeah.
And now they seem to be better able to go along with Pepsi. The inefficiencies of that now is essentially the control feels like I just,
Yeah.
we just want to go to war with Pepsi as outward its usefulness.
Gotcha. So now they can be more rational from the.
For the whole,
concentrate.
right, for the whole thing.
But I love this notion of these exclusive franchises, which live well during the day of living the regional knowledge. You have no idea what the consumer preferences were, you didn't have that machine. They were rich, and they had the ability to do it, they had information systems that were sent around. And the arcane legacy.
Well, in fact, in Europe,
So is this a market for the extended movie producing?
do you read the book on competition in Mr. Book?
We talked about
Yeah. Does that extend this model to everything?
Yeah, but like example, like like the emerging markets basically do have distribution networks.
Yes,
like,
of
that
course,
can take over
of
that.
course. But when I go to India, what do you think I tell them to do?
Buy each other.
No. This buying crap in the market. No, dominate local markets.
Yeah.
So for either whether it's healthcare or drug distribution or soda distribution or anything, you pick a geography and dominate that first. And then when you do brand new products, pick a narrow niche and dominate that first. Dominate it.
So I mean exactly your comment in recent conversation. We said, look, we don't want to be 10% of the world. We want to be dominant.
Yeah, we had a huge fight with them. I left because I was in Palm reading. All we wanted to talk about was how Heineken was a global brand. And we tried to talk, use that stupid.
No, that has been their route to where they are today, but that is not all the way.
Right, not in Nigeria.
thoughts on American Airlines away from tobacco space. Saying tobacco, any distribution, not sort of retail, but in production, AOI. Except on a piece of, where it's like a, yeah. I look at this as a working capital issue going into that when we're in this process. But beyond that, government support, it's obviously very level business, but I don't know if you have any insights. I know that's like
I
that's
always lead process, so I never really and it's super and the manufacturers
Remember,
given a
to protect local share, what do you mean? No, the local share is what gives you variance. The local economies of scale give you variance. But what do you need to keep somebody from stealing your local economies of scale? No, you have to have captivity up here. Because if they can come in and steal those customers now, do those new processors really have captivity to protect them? Yes or no? Because that's the crucial question.
I would say that's a fair thing. It's not as
It's obvious, so that's what you got to figure out.
And what's happening is that they become the whole system change. They actually lend to the company.
Right.
So it's becoming more capital demanding business because they actually are descending from the lower employees who is auction business.
millionaire farmers, or maybe less. There's always all the subsidies on that.
Yeah, it's such a change that it used to be reported by all this conversation. Amazing how the tobacco industry is how few ultimately of the national constituencies stood up for the industry again. We very much fought, Congress fought, nobody basically stood up. And so,
Here we see. Don't look at the very important.
yeah. And so, and the industry, I don't think did a good job co-opting to be their soft lawyers. They did their wrong.
Right. No, I'm-
They didn't just stop. Because I mean, North Carolina farmers were bought out, sort of became different. And ultimately, they lost the lease because they mistreated those decisions. They charged, they paid too little for the retailers to create products. And they gave the farmers to needs here, and they lost their rates. But naturally, the line was like a lot of votes.
Anyway, Scott, why don't you, if you want to write a paper for this class, tobacco process.
Very
You
interesting.
know,
Evaluation.
right, and you know, and you know what the crucial questions are.
And you've got some great variety. You've got Universal, which is the FEMA, which does all of the Universal business. You've got AOR, which does then you have the residual that's still processed by Reynolds itself, which is free to go to the marketplace on the current regular scale. It's a very scale as a business, and it was very interesting because it was, they had these facilities that were only used 3 months of the year. And so they constantly try to figure out ways to do year round.
Yeah, sorry, it's your wooden net, which is time.
Yeah, and Buffett, once made a point about seeds chart. He said, in order to make a good return on annually, say, you want to lose money a year. Because he realized that you can't think about seeds as dead weight of the 11 months that it did no wrong. Because it had the credibility that when you went there for the 1 month and you had to buy stuff, that you felt comfortable doing it. If they had taken the fact that it was empty for all those months and said, I don't really go to this yard and let's sell coffee here, because otherwise we hire these people, they come in and they sell a single stick can for 4 months in a row. Why do you want that dead weight? And Laura's point was because you make so much money when you make it that you have to maintain that credibility. You can't mess with it. Even though from a consultant's perspective, they would say, oh, I need really improvement programs here for the months. HR rock on the same problem. Why do we go into retail software and we're only this one? Because they're not particularly automated. So we use those people for 11 months of the year and and this business is often stumbled because like they want other businesses to sort of give them activity over the 9 months here in the factors process. And I think that's a bane of businesses that to make money for the whole year, you have to pay money for investment. And the problem is that you get to the level loan, you don't get to pay. And they're announcing, right? You got to announce it.
So you got all the issues of scripts. That's a good one. Scott, it's a good one.
Let me see. If you have any questions, we've had a dialogue with Universal for a long time. I have looked at AI since I lost an enormous amount of money years ago. It was dying, there was a month lost it, and I lost more money than I stopped. I was thinking about it. And at the end, I feel like it's a good thing.
Well, again, nothing's a commodity. There are economies of scale on the side.
Yeah.
And you don't have a beginning of time. I mean, again, Housing Guard Network is a lovely little entertainment. You have a house program where the obvious outlet for it is get much more exposure. They're going to pay more for the best programs. It's a fixed cost. Everything about it is lovely, except, as the question raised tonight, if on the other side you got another monopoly,
More power.
it's a tough balancing act, and that may be the issue with these tobacco processors.
We certainly have not free buying.
And if those buyers cooperate, you know,
But I'll tell you something, if you want, the head of international course recognizes that they, Philip Morris, got themselves badly short week over the last 18 months, and he threw their teeth over it. And he's just so livid about being held up by the tobacco leaf merchants. But he says we have to better understand that they have to make a regular living, and they can't expect to gouge us when we're short because we have our members. And so the ultimate message is that you should be allowed to make a reasonable return, no more than average.
And what's the part of the strategic behavior course that's about?
Then you should be able to make,
A reasonable, how do you define a reasonable outcome?
how you find a reasonable outcome.
Well, you guys will do well to read this book.
I read your conversations at the.
Right, okay, so what's the chapter that tells you how this is going to work out? It's the bargaining chapter. And
what is the
better-
bargain?
Better pricing, better cooperation pricing.
Well, it's partly that, but it's also that you maximize the joint profit, which the tobacco companies do. And then you divide it up. And what's the first principle of dividing it up fairly?
No taking any pressure.
Well, no, how do you define the fair share? What's the
Market share.
No. It's realistic. The first thing we have to look at is nobody takes anything, everybody takes anything what they bring. So whatever the non-cooperative equilibrium is, that's what people have to start with. Okay? So if the tobacco companies have lots of alternative sources of tobacco in the non-cooperative equilibrium, how much money do the leaf suppliers get?
Not a lot.
None. You get a competitive return, that's it. Okay, so it's the back end. And that's what you have to think about first, too. This is argument. And what's the second principle? Jump in! Jesus. If above the threshold, things look symmetrical, how do you divide the jointly dependent thing? Equally. And then what's the third principle? Now you get it. If they're big and small above the threshold. So there's opportunities set for one guy is uniformly bigger than the other.
That's it.
No. You divide it proportionate to the level of the opportunities.
Okay.
Market share.
Market share.
Read that chapter.
I think we're always on the lookout for our unfair share. That's what.
But in number, you see, in the long run, the tobacco guys, in the long run, you shouldn't have you gouge them if they're going to get more.
Yeah.
And if you commit resources based on the hope,
Yeah.
if you're going to get more than your fair share over a long period of time, you're going to lose money because you spend these periods of non-agreement when everybody gets it. And long run, they're going to punish you. And you're not going to cooperate because everybody's going to say, oh, fuck these guys.
Yeah.
So that's why understanding these principles of fair share.
And the beauty of the business also, is that tobacco is probably less than 3% of the manufacturing cost. What they should really value is consistency of product, certainty.
Well,
But what manufacturers really care about is the bad batch. If they have a bad batch that has ammonia in something, they're screwed. And then there's also confidentiality, because they can't trust them by going out and saying, yeah, they're pretty good for some stuff, they're sweet. They have to be able to trust the people. And they have to be able to trust the products.
It's not the hard.
No. It's still not, because ex post, all these things apply.
Yeah, this is.
But ex ante, before you sign somebody up, you can negotiate a long-term contract because you've got these ex post considerations.
Yeah, you have.
What's the competition like up front among the beef producers?
Trust is a really big area.
And the trust has to do with the price, the long-run price too. Oh, so it's good we have this money.
I wish I looked at it more.
This is a great paper for you to do. This is a great paper.
Yeah.
This is one of those things.
I gather.
That's fine.
That's good. No, the stars stay late. I know that. That's part of the
Thank you very much. I just ran one thought. As on the distribution model that you are coming like NDR in the healthcare space.
I think the healthcare space is just so unknown.
Yeah.
Think about this.
That's all.
They're doing victory laps. What's the probability that the side effects is easy or more than what the And you know why there's no probability? Because it's not even there. They're asking for a look, they get the privilege of the victory laps. And this will not see the light of day. And so, and given that it's so
Yeah. But this is just that huge, I guess, as you said, multiple channels of distribution that they can use for their existing products as well as new products.
Tom, I've got to run, unfortunately. But thank you
Say
very
hello to
much.
your lovely wife and your daughter as well. Is she still riding?
She's in Aix-en-Provence.
Oh,
She's eating at a fancy restaurant. Okay,
Goodbye,
so
nice
I
to
will
meet
look
you.
at it.
Yeah, good luck
That's
with
a
your
great
paper.
paper.
I want to see it. I'd love to see what comes out, because it's as Bruce said, it's an intricate multi something that needs both sides. They need each other. Desperately need each other. They need the predictability that can come from the source of supply. So what took her over there?
Sorry? Oh, no, she's not her name.
He's
Because they can
He went to New Zealand.
Oh.
He went to the southern.
I see.
To the
Yeah,
southern.
so you're like a-
Yeah, he went to the southern. Is he not in this?